What if Warren Buffett told you that fear is your friend in the stock market? While headlines scream panic, Buffett is doing what he always does, staying calm and buying quality. At the 2025 Berkshire meeting, he reminded investors that market crashes aren't disasters, they're discounts.
What has happened in the last 30, 45 days, 100 days, whatever you want to pick up, whatever this period has been, is really nothing. There's been 3 times since we acquired Berkshire that Berkshire has gone down 50% in a fairly short period of time, 3 different times. Nothing was fundamentally wrong with the company at any time, but this is not a huge move. The Dow Jones average hit 381 in September of 1929. It got down to 42. So that's like going from 100 to 11. This has not been a dramatic bear market or anything of the sort.
Wall Street isn't just jittery, it's in full-blown turbulence. Tariff shocks are ricocheting through headlines, interest rates are playing a guessing game, and global tensions are only turning up the heat. Tech stocks are zigzagging like roller coasters, industrials are feeling the squeeze, and retail investors? Many are heading for the exits. It's not just fear, it's full-scale panic, driven by everything from China's retaliation strategies to inflation curveballs. Just in the past few weeks, billions have been yanked out of equity funds as doom and gloom stories dominate the financial airwaves. But then, silence shattered. One voice cut through the storm like a lighthouse in the fog. It was Warren Buffett. At the 2025 Berkshire Hathaway annual meeting, the Oracle of Omaha didn't flinch. He didn't scold, didn't speculate, he steadied the room. Calm and collected, he reminded investors that what we're seeing isn't unusual. In fact, Berkshire Hathaway has taken a 50% nosedive, not once, not twice, but 3 separate times. And every time, it wasn't because the business was broken, it was just the market doing what markets do. His reminder was simple but piercing. If it makes a difference to you whether your stocks are down 15% or not, you need a somewhat different investment philosophy. Sometimes all it takes is one voice of reason. And that brings us to the real question: how should you respond? Let's get into that. But more importantly, let's talk about the opportunities fear is hiding. We're starting with a titan that barely needs an introduction. Apple Inc., ticker AAPL. For years, it's been the crown jewel in Berkshire Hathaway's portfolio. Even after trimming the position, it still stands as Buffett's single largest holding. And there's good reason. Apple isn't just a gadget maker. It's a global ecosystem that continues to thrive, even when the world is on edge. In the face of China headwinds and rising tariff chatter, Apple just delivered a monster quarter. $95.4 billion in revenue and $24.78 billion in net income. iPhone sales? They alone brought in over $46 billion. That's nearly half of all revenue. Yes, China sales dipped, but US sales jumped 8% year over year, proving Apple's grip on consumer loyalty is as tight as ever. Here's a neat fact. Apple became the first publicly traded company to hit a $3 trillion market cap and stayed there longer than anyone expected. Buffett's philosophy fits Apple like a glove. It's not about the bumps, it's about the brand, the moat, and the staying power. Apple's value doesn't vanish with headlines. In fact, this next chapter may be even more intriguing. Here's where it gets interesting. Apple is now laying down the groundwork for an AI-infused future, quietly, but with intent. It's investing $500 billion in US operations, partnering closely with TSMC, and paving a path from iPhone chips to AI-driven data centers. This isn't just about keeping up, it's about leading. And despite all of this, Apple stock is still down nearly 15% year-to-date. That's not a red flag, that's a setup. Just like Berkshire's past crashes, this may be the window that future investors wish they hadn't missed. By the way, if you're getting value from this analysis, a like and subscribe goes a long way to support my small channel. And if you've ever thought about adding gold to your portfolio, I've got a free gold IRA guide linked in the description below. I'll break down why it's worth a look at the end of this video. And now from one tech titan to another, but this next one is all about firepower. Let's talk about NVDA, the quiet engine behind the AI boom. You might know it for its chips, but this company is doing far more than powering video games. NVIDIA is the heartbeat of artificial intelligence. Its GPUs are running everything from ChatGPT to Google's data centers. Yes, the stock recently slid about 30% from its highs, but don't be fooled. This wasn't a fall from grace. It was fear, fueled by news around Huawei's 910D chip and US-China tech battles. But here's the truth. Nothing out there comes close to dethroning NVIDIA's current reign. Huawei's chip might grab headlines, but there's zero third-party data proving it can match NVIDIA's H100SS, let alone the next-gen Blackwell architecture already hitting the market. Here's something cool. NVIDIA's CUDA platform has been downloaded over 40 million times, and it's still the industry standard for developers building cutting-edge AI tools. And the financials? Stunning. NVIDIA posted $39.3 billion in quarterly revenue, a 78% increase year over year. Non-GAAP margins hit a mind-blowing 75%, and annual net income climbed to $74.3 billion. Plus, with a fortress-like balance sheet, a current ratio above 4 and minimal debt, NVIDIA's financials are as strong as its tech. Export restrictions to China? Already priced in. And here's the kicker. This stock that usually trades at 50 to 60 times earnings is now sitting at just 24 times forward PE. For long-term thinkers, this isn't fear. It's a flashing green light. From AI supremacy to cloud dominance. Our next stop? A company woven into the fabric of modern life. Enter Amazon.com Inc., AMZN. After a 28% pullback, Amazon is now trading at levels that serious investors are watching closely. Behind the headlines, behind all the tariff noise, inflation chatter, and recession talk, Amazon just delivered one of its most powerful quarters yet. In Q1 2025, it brought in $155.7 billion in revenue, beating estimates across the board. But here's what matters more. AWS revenue jumped 17% year over year, and its ad business grew by 18%. This isn't just a rebound, it's a reinvention. Did you know? Amazon's AWS division is so influential that if it were a standalone company, it would be one of the top 25 largest US corporations by revenue. And this growth isn't just wide, it's efficient. Amazon's economic profitability, a metric that measures returns above its cost of capital, has been rising steadily since early 2023. Even more impressive, the forward PE ratio now sits at just 30.76 times, well below its long-term average of over 60 times. That puts it in the same valuation ballpark as Walmart or Alibaba, but with far broader reach, spanning e-commerce, cloud infrastructure, digital streaming, and AI services. Its return on equity is above 22%, and return on assets is climbing past 10%. This is a company scaling smarter, not just bigger. Yes, risks remain. Geopolitics, tariffs, consumer pressure, they're all in the mix. But Amazon, like Berkshire in past downturns, is built to endure and emerge stronger. This could be one of those rare moments where the market gives you a discount, and you take it. So what ties all of this together? Buffett's message. Don't let panic drive your decisions. Volatility may feel like chaos, but it's often just mispriced opportunity. And in a storm like this, it's the strong, steady companies that quietly set up their next big move. Ready to see where the smart money is going next? Let's dig deeper, because the market isn't done surprising us yet. The stock market's been jittery lately, especially with President Trump's new round of tariffs stirring up global trade tensions. And when uncertainty rises, history shows us where smart money tends to go: gold. Central banks' demand for it last year alone reached a record high, and spot gold just surged past $3,300 an ounce. And recently, it has surpassed the Mag 7 as the most crowded trade on Wall Street. If you're thinking about ways to take advantage of gold in your investments, I found a company that gives Americans a free guide on how to add real physical gold to their retirement portfolio in a way that's simple and secure. No sales pitch, no pressure, just honest, helpful information you can trust. Click the link in the description to get your copy now, because when the biggest financial institutions in the world are quietly stockpiling gold, it's not just a trend, it's a signal.